A lot of people just love to hate the dollar. And every time it goes down for a couple of days, they come up with a theory that the dollar is about to die. There's not really any evidence that there's a big exodus from the dollar, right?
Jens Nordvig, founder and CEO of Exante Data and market reader. It is so great to welcome you on the show. And Jens, it's great to see you. Thank you so much for joining me.
Thanks for inviting me. You had some very, very smart people on this. I thought, let's see if I can live up with the high expectations you've been setting.
You certainly can. And look, I've been reading your research since my early days starting out as a business reporter at Business Insider. I always remember when we would talk about you, Jens. So I know you as someone who focuses a lot on the macro, also currencies. And I was hoping we could kind of start with the big picture, that macro view for you today, your assessment of the economy and the markets.
Yes. Well, so maybe if you don't mind, I'll go back to last year, right? Because last year was a huge trading year for a lot of people in the macro space because we had such a pronounced upward shift in inflation that it's always easy in hindsight. But there were some very, very big macro trades, short rates, short bonds, and related trades, right? That if you could just stick to those trades the whole year, you had a very good year. Like you essentially trade as little as possible. That's almost how you made the most money last year. This year has been very different, right? It's not that we've had a big rally in interest rates because inflation is still a problem, right? Fed is still in hiking mode, ECB is still in hiking mode, and so forth. But we are at a different point in the inflation cycle, right? And we can see it with the last CPI print we had in the US, right? Market is really sniffing that we're at a turning point. And I think it's absolutely right that there is some form of turning point going on with inflation where goods prices are actually dropping. On many metrics, prices for goods are falling right now. So that's certainly different from what we've been seeing in 2001, 2022, when you went to the supermarket and something suddenly was up like 10% from when you last time visiting. So that is the bullish arguments for buying bonds, that kind of thing, related assets. But the problem is that the CPI basket has a lot of different stuff in it, right? So services is totally different. We have a very tight labor market still. And it's not just in the US, like in Europe, unemployment rate is the lowest since the euro was created, right? So it's sort of it's just a weird cycle we're in, right? Where we have a lot of people feeling pain. They don't like the inflation. Real incomes have gone down. But then you look at standard labor market metrics and labor markets are strong. And there's not really any evidence that people are getting laid off. So you have strength there. And that's then showing up in the services prices, right? So services prices have not really rolled over in a decisive way. So we've at a point in the cycle where there's going to be fighting within the central banks about, okay, should we use the goods prices as a leading indicator of what's happening to inflation? Or do we need to be very careful because services prices are still high? And that's why the central banks become so unpredictable. And the rates market change their minds every few weeks. And well, we're going up or down, right? So it's become a much more tactical market. So I think the key thing for sort of medium-term strategic macro trading is to find when the real inflection point is there. When is services prices going to go hand in hand with these goods prices that are low now? And I don't think we're quite there, but maybe in the fourth quarter, we'll start to really have some clearer evidence in that.
What would that, just out of curiosity, like that inflection point, what kind of evidence would what would you be looking for?
So, well, in the US, right, there's a very heated debate going on about whether the inflation we had was supply side driven and demand side driven. And it's very hard to separate those two things, right? Because the supply gets tight if there's a lot of demand, right? So they're two sides of the same sometimes. So at this point in time, we have a situation where the demand had been boosted by very large transfers, historically large transfers. And that has been sort of going through the economy. It's not something that takes a couple of months before that big stimulus has worked its way through the system, right? We've had a lot of talk about excess savings, and on some metrics, the excess savings that were generated by those transfers have come down. But it doesn't look like they're fully exhausted, right? So we still have some of these stimulus effects that are actually supporting certain types of consumption, and that is lengthening this cycle. At the same time, we have this very ironic situation where central banks are raising interest rates. And actually, if you look at overall financial conditions in the economy, right, where equity prices are, where credit spreads are, and so forth, financial conditions have actually eased quite meaningfully. Eased, I would say, dramatically since October last year, when markets were in sort of a turmoil period and we had the energy crisis in Europe. But even in the last couple of months, we've had financial conditions ease, right? So all those people who are thinking, okay, as soon as inflation starts to show some declining momentum, the Fed will be able to cut rates. And that's what we have priced in the curve, right? Last week, when the CPI came out, we moved to a very quickly priced, okay, we're going to have 150 basis points of cuts next year, right? Dramatic cuts. But think about it from the Fed's perspective. They're looking at a situation where they cannot see really any weakness in the labor market yet. The inflation is moderating a bit, but still way above target. And certainly the stuff they think is sticky is way above target, i.e. the services, right? And then the third thing that has been super important for monetary policy over the last couple of decades, what are overall financial conditions doing? Like, you remember, they always got forced to cut when the equity market took a dive, right? Think about end of 2018 and into 19. It was really the equity market weakness that pushed the Fed to cut rates. Now we have the equity market going up in a very dramatic way. There's no pressure on the Fed to get dovish from financial conditions. In fact, the obvious, there's pressure of them to stay hawkish for longer.
Just is that surprising, or is it kind of, I mean, I don't know. I'm definitely not an expert, but like when I look at the market, especially in this like rising interest rate environment, is that normal behavior? It just kind of feels a little perplexing to me.
It is counterintuitive to see a situation, right, where the Fed has moved very aggressively, and even though the pace is lower now, it's still moving, right? And then risk assets being okay with it, right? But in a way, it fits with the yield curve, right? Because we've seen the longer end of the yield curve has become much more stable. Essentially, the 10-year yields that we have now have been in a relatively narrow band really since October last year, and we're still lower than the highs from October, right? So even though the Fed has been tightening, the whole yield curve has not moved commensurately. So in a way, you can say that the equity market is consistent with the long end of the yield curve, kind of sniffing this turning point coming and pricing that soft landing, if you will.
Yeah. So do you think like the markets are pricing in or a soft landing? What is your expectation on the landing scenario? Do you see a soft landing or hard landing? Where do you kind of stand there?
So I don't think there's any evidence in normal indicators and also the alternative data that we track aggressively every day that the economy is about to tip in any dramatic way. And I think it has to do with, there's still some hiring that hasn't been done. Like there were jobs that were eliminated, right? And there's still people coming back to work. There's still a reopening process going on, even though it feels like a while ago since people really talked about COVID from a market perspective. It is still something that the reopening process is not fully complete yet. There's the excess savings dynamics that's not fully complete yet. So the economy is not about from one day to the other, right? And then there's stuff going on in the interest rate sensitive sectors that really have surprised a lot of people, right? So house prices have come down a bit, but the contribution from housing construction and so forth was negative for a couple of quarters, but now it's stopped being negative, right? And part of that surprise, I think, is that a lot of people like to compare with 2008, right? So we had just a nasty cycle in 2008, right? Credit was really experienced a sudden stop, right? We had such tension in the financial system that there was a sudden stop in credit. Even money markets broke down, right? And in addition to that sudden stop in credit, we also had much more of a buildup of leverage and overbuilding in the housing market in the period in the run-up to 2008, which didn't really happen in this cycle, right? A lot of financial market participants and a lot of economic agents have actually been very well behaved in the last 10 years. So we haven't built up so many excesses. So there's some resilience in the system. And that means that even the interest rate sensitive sectors, such as the housing market, is actually not doing that terribly. Like we're not as hot as we were a year and a half ago, but it's not a terrible situation either. There's actually parts of the United States where house prices are still going up. Around the world, a lot of what we're seeing is that we had like a kind of almost like a mini bubble going on in house prices, right? Mm-hmm. Like a very steep trajectory. And then we came down to earth, but we're actually stabilizing after just having dropped a little bit. And we're still up like dramatically from 2019. That's the situation in the UK. That's the situation in a lot of European markets, right? So the housing market is not crashing. It's taking the top out, but it's not crashing, right? So obviously, if you look around the world more thoroughly, like we have one big country where the housing market is absolutely crashing, and that's in China. And that's totally logical in the context of the comparison with 2008 in the United States, right? Because China had an incredible amount of overbuilding, like way more overbuilding than you ever saw in the United States, right? So working through that overhang of excess supply of housing in China, especially since they have demographics that are turning very negative as well, is going to be a multi-year process, maybe a multi-decade process, right? It's not an easy problem to solve for them.
Yeah. Well, I can tell you here in the US, as someone who wants to buy their first home, I would like the prices to come down. It's pretty crazy, like I don't know. It's crazy, like what the houses are going for, in my opinion, at least where I'm living. You mentioned we were talking about like rates. One of the areas I want to bring up with you, just especially given your background, I know you ran the currency strategy at Goldman for many years. I want to hear from you, Jens. What is going on with the US dollar? Can you fill us in on what's happening there? I keep seeing headlines around weakening. Just want to get your take.
Yeah. Well, so the first thing I would say, and I wrote a Substack about this that was called A Brief History of Dollar Hatred, right? A lot of people just love to hate the dollar. And every time it goes down for a couple of days, they come up with a theory that the dollar is about to die, right? So we can get that out of the way. I don't think the dollar is about to die, but it's a totally separate discussion to think whether there's some structural thing going on that's gonna like cause a huge structural existential crisis for the dollar, and then forecasting maybe it's going to go down 10%. Those are those two separate things for me, right? So I don't see anything in the data we track at Exante Data. We track essentially all capital flows in the world that we can get our hands on, right? And there's not really any evidence that there's a big exodus from the dollar, right? And the easy chart, if you want to look at one chart to see if the dollar is in trouble, you can look at how dollar CNH, like the Chinese currency, is trading relative to the dollar, right? And the Chinese currency is in trouble relative to the dollar, right? So if the Chinese currency was the main alternative to the dollar, you can certainly not see it in the chart of dollar CNY or dollar CNH, which is the international traded version of CNY. So that story is overhyped. Not really what's going on, right? But let's talk to the actual forecasting when we've got that kind of crazy stuff out of the way. In terms of the dollar outlook, I think it's worth thinking about the big cycles we've had for the dollar, right, over the last 25 years, right? Into the global financial crisis, the dollar was very, very weak. Over a multi-year period, had a dramatic move. Like we essentially had a euro dollar 100% higher from like 2002 to 2008, right? So dollar was very weak in that period. Then the global financial crisis came, The dollar got a boost from dollar shortage and so forth. And then we had a wave of dollar weakness again when the global economy recovered in 2009 and up until about 13. Dollar was weak again. People talked a lot about too much QE in the United States and so forth. But then really, since 2014 and now, so almost 10 years, the dollar has gained a very, very big move in the dollar against a lot of currencies, right? And that has a lot of logical reasons behind it. We've had pretty weak global growth in most of that period, especially before the COVID shock. The Fed had a tightening cycle in 17, 18 that others didn't have, right? So they were able to raise rates there. And the US also got a little bit lucky because they found a lot of commodities on the ground that helped the balance of payments. And so all those things supported the dollar. And now the dollar has gotten so strong that I think we've come to a point where it's actually pretty hard for it to gain much further. So I think there's sort of a long-term valuation argument that is starting to come into play. And I think you can see that from how the dollar has been trading over the last 9 months, right? That there's, even in those periods where the US data is very strong and the Fed moves very aggressively, okay, the dollar moves, but actually sort of the beta, if you will, the juice that the dollar gets out of that good news is not so high. So I think that's just a market signal that the dollar is starting to run out of steam. And then I think from a flow perspective, and I really like to crunch the balance of payments, right? The balance of payments in the US also starts to remind me a little bit of how the US balance of payments looked back in the pre-global financial crisis days. Like, we have a pretty big current account deficit. And if you look at, okay, how's that financed? It's really just financed with debt. Not a lot of foreign direct investment into the US. And we had sort of a perfect storm, if you will, like where in the COVID shock, there was a period where US equity markets were outperforming dramatically, and everybody around the world just thought, okay, US equities is the growth asset in the world. I have clients all around, all right. In Brazil, they were focused on US stocks. In Singapore, they were focused on US stocks. That was what they were trading. But that is also not so much the case. Even with this AI kind of focus you've had over the last couple of months, that has actually been more of a US domestic flow story. That's something international investors have been buying into aggressively. So the balance of payments looks a bit weak. And I'll just mention one more thing. When interest rates rise, and you have a lot of debt that is owned by foreigners, then it's just very simple math. Over time, you'll have to pay higher interest on those bonds. It takes a bit of time before the coupons roll into higher coupons, right? But now we've had high interest rates for almost 2 years, right? And they'll continue to reset into higher coupons. That's going to actually be a problem for the balance of payments because we have to send those interest rate payments aboard, and that could probably generate up to 1% of GDP drag on the balance of payments. So if you think the current account deficit is 3% now, all else equal, maybe it's going to be 4% just because of those interest payments going higher. So that's another problem for the dollar on a forward-looking basis. So those are some of the things that I use in my forecasting. Not, I think the dollar's going to die tomorrow, but those types of arguments I think are better for forecasting.
Yeah, it's again, like, given your background and experience, it's interesting. I love like asking that question. I want to hear what folks think, and it's helpful for everyone who's watching and listening. I guess a follow-on question is on the weakening dollar. What does that mean for investors? Like, how does that impact? Like, does it have an impact on equities? Does it have an impact on commodities? Is there anything that folks should be thinking about?
It impacts everything, really. If you have any form of active investments, I guess some people have a 401k, right? And they never look at what's in there. That's one way of investing. That's the kind of Vanguard philosophy, right? But most people want to be a little bit more active with their risk management. They don't want to take massive drawdowns if there's a big shock to the economy, being it COVID, war in Europe, or whatever can go wrong, right? So if you have a somewhat active approach, the dollar is relevant, even if you're not like a huge currency trader directly, right? Because it's going to impact whether your international equities are doing relatively well. Like, the dollar is incredibly important in relation to how your international equity investments are doing, right? If the dollar has a bad year, down 10%, right, you can have massive underperformance of the S&P versus international stocks and really still do better in terms of having international exposure, right? So that's one part of it. And there's certainly also a correlation between what the dollar is doing and global commodity prices. So it could be relevant through that channel as well. So everything's connected. And you have to pay attention to the dollar. It's a crucial variable for all financial markets.
Yeah. Well, Jens, in this conversation, I did hear you bring up artificial intelligence, and we need to have this discussion. And I want to hear what you are up to, what you are building with Market Reader. I know it involves AI. Can you fill us in on what you've been working on?
Yeah, I'll be very happy to. In most of my career, I've been helping very large institutional investors making money, right? That was the job I had at Goldman that you referenced earlier, right? At some point, I was head of research in the mortgage securities, where the goal was to advise, big asset managers, hedge funds around the world, that kind of thing. And the company that I started in 2016, called Exante Data, really also serves big institutional money managers around the world, managing macro risk from a sort of a data-driven standpoint. So the idea behind Market Reader was, in a way, to do something that was a bit the opposite of that. Like, we really wanted to do something that is a tool that pretty much everybody who has a formal investment is trading in some capacity can benefit from. So what Market Reader does is that it literally tells you in an objective way why the market is moving, right? So if you own, some bank stocks, which has been moving this week, right? Market Reader will tell you, okay, Morgan Stanley was up because of good earnings, but it'll also tell you that, Raymond James was actually up just because it moved in sympathy with Morgan Stanley. Market Reader is a complex engine, a complex technology that knows how different financial markets are interrelated, and it can draw inferences from one security to the other. And we have an overall system that essentially tries to replicate how, a top trading desk in a hedge fund or an asset manager will analyze information, but do it in a totally automated way that we can then put in front of individual investors as well, that don't have like a whole army of traders that consider watch the market for a huge portfolio, right? But we're trying to essentially create a piece of software that can do extremely sophisticated analysis on scale. Like, for literally every asset in the world is our ambition. At the moment, we have 11,000 assets in the system, but we can do all of that in real time, which no human would ever be able to do in a timely way. And it gives a really incredible insight into the market. Like, this year has had some incredible swings, right? We had the Silicon Valley Bank crisis, right? So that's the most obvious example of Market Reader giving a leading indicator that Wednesday night. I literally never pulled up Silicon Valley Bank on my Bloomberg or whatever I'm using, right? But Market Reader flagged, okay, it's moving, and everything that was correlated, First Republic Bank and so forth, to give you an early read on something that is very important. So it can help you absorb information better, faster, in a very objective way. No offense to journalists, but obviously there's some journalists who work in financial news. It's sometimes you feel like, their job is to write stories, right? So they ex post, they will write stories that try to rationalize what's going on. And some of them do a fantastic job and do good stories, but sometimes you feel like, is that really what is going on, right? So I think having an objective method that just crunches the data, crunches all the information out there, and tells you, okay, objectively speaking, backed by statistics, this is what's going on, I think is very helpful.
Yeah. Well, I'm going to ask you a bunch of questions because this is interesting to me. Wait, when did you all start this? Market Reader.
So it's something that we've been thinking about for quite a while. So my CTO at Exante Data and I were chatting about this for a while, right? And then we pulled the trigger about 2 years ago. and we founded a new company called Market Reader Inc., where we wanted to do this technology. And initially, it was really focused on what I would call hardcore finance models, like we model what's going on. And it is only in the last 6 months that we put the AI on top, right? So the developments within the AI space are moving so fast that we could see, okay, we have to essentially have an AI layer. And actually, that's a bit too simple. We have multiple layers. So the AI can certainly be used from a presentational perspective, right? Because if we have, an army of models that have, 10 different things to say about what's going on in a certain stock, for example, right? It becomes a bit of a dense piece of content, and how do humans absorb that? So if we have the AI actually generate some text that in 3 lines of text gives you the gist of what's going on, it's actually much easier to absorb. There's a reason why Twitter was successful when it launched, right? People like those short bits of text, and it's a way, that feeling we're trying to replicate with explanations of what's going on in the market, as short text as possible to give the gist of what's going on. And that way you can scan, for example, if you own an ETF, you can click into it and get, okay, all the different constituents. You can scan in a second what's going on with them. And the AI is important to allow that summarization of incredible amount of underlying information.
Yeah, I was going to say, like, the world changed on November 30th, 2022, with the introduction of ChatGPT, and obviously all of the developments we've seen in AI in the last 6 months, as you put it. The AI part is also interesting because we were talking earlier about like the macro outlook, that longer term macro outlook, and it sounds to me too like AI is an important part of the macro as well. How do you see it fitting in to your macro outlook?
Yeah. So I think the first and very tangible thing, this is the easy bit, and we're going to get to the hard bit in a second, but the easy bit is that it certainly helped the stock market, right? We have a number of big names that are benefiting dramatically from positive news around AI. We had an incredible example. Like I think I tweeted out from the Market Reader account as well earlier this week. Like Microsoft added 150 billion market cap in a couple of hours from announcing a new AI product, right, for corporates. Those are big numbers, right? And we've seen many of the examples that's obviously in the semiconductor space, massive moves we've seen, right? So it's already lifted markets in that front, and that I think is relevant for a lot of other assets, right? Like there would be a big difference for the Fed, right, if the equity market was down 20%, right, but now we're approaching being up 20% from the lows we saw earlier. So that's the simple bit. The complicated bit is how's it actually going to impact the economy, right? It's pretty obvious that there's certain companies that are going to benefit dramatically, but what about the economy, right? So if I'm going to be a little bit pessimistic from an economic perspective, I'll outline the pessimistic scenario. That is, even if we're going to have some companies benefiting dramatically, I think I'm worried about sort of two trends that could really be negative. And the one is that if it's extremely concentrated in a few big companies that have, large training data and that kind of thing, it could be very positive for them, but they might actually outcompete a lot of other smaller companies that just don't have the capacity to bring AI on board quickly enough to survive. So that could create a massive disruption and potentially create problems for a lot of smaller companies. So that's sort of one angle. The other angle is that it's also highly likely that the jobs that are going to be facing the most competition are essentially the services sector jobs that are sort of the most, repetitive tasks and so forth. So it's probably going to exacerbate problems we've already seen in terms of inequality, right? People who are AI experts probably going to be paid pretty well. People who have, relatively repetitive services sector jobs are going to be having issues. Think about stuff like call centers, right? A lot of that is going to be done by AI robots soon. It already is, but it's going to be more and more and more, right? So people who have those types of jobs are going to be having a hard time competing with the AI technology. So I think we could have more income inequality. And we also know that income inequality is bad for overall growth, because it tends to be the case that the folks who have high income have higher savings rate. Folks who have low incomes have lower savings rates. So actually, when the economy grows very much in the top, it doesn't generate so much consumption. And that could be a problem for overall growth. So I think that's the sort of negative implication that you could envisage. So you could have a situation where if you think about inflation, right? And one way to think about inflation is, okay, wage growth is an input in inflation. Productivity is an input in inflation. So if you have a certain level of wage growth and productivity goes up, then you would think the equilibrium inflation rate is actually lower. So that could be the case, especially if we don't get a big boost to consumption, because you have a very unequal distribution of that income that's generated. That's the sort of bearish scenario that I worry a little bit about, not for the next couple of months, but if you think, 5 years ahead, when people have really adopted these technologies more thoroughly.
Yeah, longer term. I guess maybe thinking, and it's probably too early, but just even thinking about it, and maybe what do you kind of envision, like from a Fed policy perspective? Do you think that they will have to really take into consideration the impact of AI, and especially in their policy making, go for like in the future at some point?
Yeah, I think there's going to be working papers written on the impact of AI. There are already good working papers. Maybe if we tweet a little bit around this podcast afterwards, we can add some references there. But I think the problem that the Fed is facing is that this is a very uncertain process. It's hard for them to really make policy based on some fantasies about the future that they don't have high conviction in. So I think also, because central banks have had such poor forecasting track records over the last 2 years, it's hard for them to really make policy in an aggressive way determined by their forecast, right? So it used to be the case that when you thought about inflation targeting, you would say, okay, the relevant variable for how central banks are gonna set interest rates is really what the inflation forecast is. But that's kind of changed in the last year or so, right? There's much more focus on what realized inflation is, right? And that's because they just don't have that much conviction in their own forecast anymore. So what I'm trying to say is there's going to be working papers about artificial intelligence and the impact on the economy. But until the Fed sees it, it's hard for them to respond aggressively to it. What they can see is that the equity market is strong. So I think the very near-term implication for the Fed is that they're going to be more hawkish than was otherwise needed. And that's an argument that these cuts that the market wants to price in are unlikely to be materialized unless there's a big shock to the economy that we haven't seen yet.
Yeah, like so. You don't see the cuts happening anytime soon.
No. So I'm not saying we can't have some form of cutting if inflation really comes down, right? I was on TV live when the CPI numbers came out, and I think I was pretty clear that those were important numbers. They were low. We'll see if we can repeat as low numbers in coming months. I think we are setting lower, but we also were so far above target, right, that just coming down a little bit is probably not enough. But you always have to compare with what's priced in the market, right? And on Friday, we had 150 basis points of cuts priced for 2024. That's not a little bit of cutting. That's aggressive cutting. Mm-hmm. And I just don't see why the Fed would be in a rush until the economy has really rolled over, right? And the economy seems to be experiencing moderate growth, but there's no real evidence of incremental slowing, right? It's almost like in the last 3-4 months, we've stabilized at this lower growth pace. And a lot of people are waiting for, next shoe to drop, some big deterioration in the economy, but it's not really showing up. And I think it might be a story for that could be a year out.
Yeah. Yeah. Going back to the AI discussion too, you're outlining like some of the, potential negatives from AI. From where you sit, what are some of the positives that you're thinking about?
Well, I can see it already in our work, right? If you want to, like, I'm just going to give a very simple example, right? Even from day-to-day work that you do as a researcher, like if you are going to research a topic where you're not a total expert already, but you just want to get a primer, okay, what's going on with, composition of energy exports in Russia. So that's probably a bad example. I know a little bit about that, but it could be something you're starting fresh on. It gives you the basics very quickly, much quicker than if you're Googling around, if you're using some of the ChatGPT tools and so forth. And then obviously there is automation you can do. Like we also, like one application we're doing in Market Reader is we can use this for kind of quality control, right? So if we're trying to analyze everything that's going on in social media, we'll have to sift through, thousands, maybe millions of posts on Twitter, posts on Reddit, other channels, right? How do you really figure out what is good content and bad content? It's hard to analyze that in a numerical space. Like numerical scoring might not be very appropriate, but there's some of the AI techniques where you can really use it for quality control. And when we absorb a huge amount of information, it can really give a totally new and more flexible type of filtering information. And that opens up new avenues of analysis. So it really opens up the door to new ways of doing things. And it actually allows you to be more creative, right? Because some of this mundane work that is annoying to do and kind of holds you back means that you can actually take a step back. You can go for a long walk and think about, okay, what do I really want to do without so much worrying about the constraints to do with data, technology, and so forth, because we're overcoming those.
That's a really interesting point too. And as, someone who's worked in finance for, I don't know how many years, but it would assume like many years. And I'd imagine you probably at some point had to do like the kind of grunt work along the way. Like, how do you see it transforming, that industry as well? Or, how do you see the impact on finance? What are you thinking about there?
Yeah. Yes, I started at Goldman in the early 2000s. And I think one example that's kind of interesting is that when I worked on the trading desk, I was the sort of desk strategist, economist on the main fixed income trading floor at Goldman, New York, when they were down at Broad Street. And one of my jobs was at the time that when there was a number coming out, such as payrolls or CPI or something like that, my job was to literally shout out as loud as I could whether I thought it was like bullish or bearish number, like ideally within 1 or 2 seconds. And then the traders would trade accordingly. That is a very, very old-fashioned way of doing analysis, right?
Did you ever mess up? Wow.
I'm sure I did, but that was the job. And you could, on average, you could absolutely make money out of that approach, right? Because you analyze very quickly. And at that point in time, there was not very good robots that analyze the data algorithmically. Like subsequently, right, we have high-frequency trading firms, typically in Chicago, right, where they're closest to the exchange that will do a lot of trading within a couple of milliseconds, right? And you can try to open your mouth and see how quickly you can shout, but you can't shout a lot in a millisecond, right? So that was just a very, very old-fashioned way. So there's all these parts of doing financial analysis that have been weeded out. That's a sort of simple example, right? But we're moving to also when I was head of research at Nomura Securities, so that's now call it 10 years ago. like almost all the number crunching was done in Excel. Almost all the number crunching was done in Excel, right? And now really we try to minimize the use of Excel, right? And we have shared databases. The coding is done in Python, right? And there's just a lot of the manual tasks that are getting weeded out. And as I said, like, in fact, that means that what you can focus on is that, okay, maybe there's somebody who wrote a fantastic, academic paper about statistics, and you can read that and really internalize it and become wiser, and then use that wisdom to do good analysis, and then worry less about the logistics and the piping and that kind of thing, because it's just getting so much better.
Wow. I'm just envisioning you like looking at the terminal to see whatever the data is and it's shouting bullish or bearish. Like, there must have been a lot of pressure, I imagine, like just to be so fast on the trading floor.
It seems a bit silly when you're thinking about it, but you could actually you could make some profits doing that.
Oh, so, yeah. I just imagine like that was like very intense too back then.
Yeah, that there was. I remember there was the head of trading. He came down sometimes before payrolls, and he said, if you don't have some adrenaline before the payroll release, you're not, you're not in the right position. So
I love that. Yeah. Probably just like all of that energy too. Incredible. I'm sure you didn't mess up. I don't know. It just feels like that's a lot of pressure to do that in milliseconds. Incredible. I also just want to hear more on, you mentioned Market Reader is for both retail and institutional. Can you tell me? I mean, I just want to hear more on like the building the business side of things. How are you reaching folks? What's kind of been the reaction so far? It's kind of interesting to me personally just to hear more of like, from a founder and how that process is going.
Yeah. I think when you're founding a company, it's important to do something that you know a lot about, have a lot of experience in. But then as you run a company, obviously there's many different tasks that have to be completed, and reaching an audience, marketing, that kind of thing that you know something about is very important, right? So it's also important to be aware of what you are very good at and what you might not be very good at. And then get help so that you can cover all the bases. So what we have done is that we initially were kind of in stealth mode, right? We were building a world-class technology to analyze why the market is moving. And then this year we've become a bit more open about what we're up to. And we've been building what we call an early access list, right? So we do some stuff in social media. We have a handle called Market Reader Inc., where we tweet out, for example. And we've been building a list of people who are interested in using the tool. And we have actually started to onboard early adopters of Market Reader this month, right? So it's no longer a project for the future. We have active users. We have some hedge funds that wanted to buy access as well. But to go back to the question about who is it for, it's our strength and weakness at the same time, right? On the one hand, we think it's a tool that really everybody can benefit from. Everybody who wants to really understand quickly and objectively what's going on in the market Reader should be helpful. But when we're setting up the business, it is hard to set up the business without knowing, okay, I absolutely want just that type of user, right? So I think over time, we'll probably end up having different tiers of the product. Where there's some for very sophisticated users that want to get a huge amount of detail, and then there's going to be perhaps something that's for people that really want to get the gist of what's going on, maybe a shorter summary, right? But the good thing is that even the very short summaries of what's going on are derived from the same technology. So it's not that they're less good; it's just a different way of presenting the information. So we hope over time to reach a very big audience. Including people who are in the retail space. And we are having this early access community that we are building, and you can sign up to on marketreader.com. And then we're trying to figure out what specific product does the private people want. We have in the team, we have a lot of people who have experience dealing with institutional investors. So it's easy for us to guess what the institutions want. It's harder for us to guess what the retail users want. So we really want their feedback. So we're trying to have as much interaction we can with those new types of users to make sure we build the functions they want. We set it up in the way they like to look at it, so we can serve a big audience.
Yeah, I have to say summarization is one of like the most interesting tasks from AI, at least, you know, in my view. I do want to hear more on the examples, because and that was interesting to me. You were mentioning like banks, for example, and you could see like Raymond James was trading in sympathy. Can you just share some of the examples of like what market reader has been surfacing? Anything to you that's been particularly interesting?
Yeah, so we talked a little about banks, and we can maybe come back to that, but I'll just give another example, right? So in 2020, most of my time was spent on forecasting COVID. COVID was the most important driver of financial markets in 2020. And we decided on a day in January 2020 that this was a big deal. And we dedicated most of the Exante Data team to forecast COVID. And we had a whole process for that. And then we've had that running for a couple of years, right? It's been less and less influential on the market. And then in January this year, when China had their COVID wave, we kind of decided, okay, forecasting COVID is not going to be something that really is going to help you get an edge on markets anymore. And then there was one day at the end of May where I got an alert from Market Reader, and the alert was, okay, Moderna is up 10% today. And the reason is that there's speculation in social media that China is just about to have another huge COVID wave, right? So that was an interesting alert. Like, I had not paid attention to COVID, right? Because I decided, okay, we're sort of beyond that influence on the market. But Market Reader gave me a heads up that there's something going on. Actually, the vaccine stocks are moving again. So I restarted my my COVID forecasting models, and we can see there was some movement, right? But my human judgment was, okay, I don't think that's going to shut down the economy, even though they might have more cases again, right? So it gave me an opportunity there to assess, okay, is this a signal we're getting from the market that we should do something with? On that occasion, the action to take was actually to short those vaccine stocks that had rallied too much on probably something that was not going to play out. But on other occasions, it's obviously different, right? So going back to March, right? In March and April, like on literally every day, we had the screener where we looked at all the banks, especially the regional banks, what was going on with them. Like, well, you remember we had, you know, obviously the first couple of days it was Silicon Valley Bank, and then we had all the cascade effects into all the other banks that were losing deposits. And every time there was somebody who was saying something worrying about the deposit, the stocks collapsed. So we could track that very carefully and very quickly. So it's given me a tool, even from a macro perspective, where I can scan a whole sector very quickly. And it's been incredibly helpful just to absorb a lot of information without doing a lot of work.
Yeah.
Like, because we are all a little bit lazy, right? If you have to like look up 100 companies one by one, you're going to end up not getting it done. And this way you just tick all the boxes and get a lot of stuff done without a lot of work.
That is the magic of humans plus machines. Right there, like that example you gave. And I do just want to hear, and I know you're it's your company and whatnot, but I do want to hear, do you think, and it sounds like I wouldn't say the answer is yes, but from, you know, where you sit, it's made you better, more productive. Are you actually seeing the results yourself from what you all have built?
Yeah, absolutely. So like I've been having access to a Bloomberg screen that it's well known, costs around $25,000 a year, right? I've used the Bloomberg since 2000, right? So that is the tool that I use. I've used Reuters Terminal and other things as well, right? My focus has historically been on kind of global fixed income markets, so interest rates, currencies, commodities, like macro assets like that. For me, it's been incredibly helpful to have a tool where I can quickly follow what's going on in the equity market without spending, you know, most of my day looking at individual stocks and so forth, right? So it gives you a way to scan, okay, I'm going to look at the market through that sector. I want to look at, okay, let me look at at all the I can filter the market how I want, like high market cap, specific sectors, stuff that has earnings. That we have a lot of proprietary filters. We can say, okay, I want to look at the stuff that's moving, that doesn't have any earnings out, that kind of stuff, right? So you can kind of go under the surface. What are the trends if you strip out the earnings? Yeah, I think I learned a lot. And we've seen a couple of examples. Obviously, we don't have a Silicon Valley Bank crisis every day, right? But certainly in that week, it was incredibly helpful to be at least 24 hours ahead of when the big moves happened.
Yeah, and you've been in this space since the early 2000s. Maybe it's more of like kind of as we wrap this conversation up. If you were to talk to like that young person today, maybe they're finishing up school, they're interested, or maybe let's say they're like starting out in school, trying to think about pursuing a career in finance, investing, and whatnot. What would you say to them? What do you think they should study? And has that changed for you given the emergence of AI?
Yeah, I do think it's changing. So traditionally, the advice I've given is that it's the very hard disciplines that are difficult to learn later, right? So the math and the statistics and so forth, it's hard to add on later. So I would get them done while your brain is the freshest and most amenable to thinking about difficult things. I think that still holds, but I think now where the AI technology is getting so sophisticated and so complex, I think there are some other disciplines that become more relevant that we have not been thinking about enough. So those would be more in the domain of philosophy, like logic, maybe even linguistics. Right now we talk about so much summarization and so forth, right? Having incredibly sharp conceptual thinking in those fields, I think, are going to become increasingly important. And I would also add like a degree of well-roundedness, like creativity is going to be key, right? Because a lot of the mundane work can now be done by robots, AI, computers, and so forth, right? So the creativity is going to have and where does the creativity come from? I think the creativity often comes from having like a very multidisciplinary way of thinking. Like you can kind of connect things from totally different topics, right? So if you're very broad in your skill set, I think that's going to enhance your creativity, and that creativity is going to be what you can use to apply the AI the best.
I love that. That is such a great point. The creativity, the well-roundedness. Jens, I've really enjoyed having you on. I feel like I learned a lot and you got me excited about Market Reader. So I definitely want to check it out. I want to give you a few moments. If you want to let folks know where they can follow you on social media, read your work, learn more about Market Reader, and also any parting thoughts, anything that we didn't bring up in this conversation, that you'd like to leave the audience, please take a moment to do so.
Yeah, so just in terms of Twitter, right, I have a handle that's called Nordvig that I'm relatively active on. And I have been getting some more followers as well. It was very hard to get followers when I was back in the banking days when you're not allowed to tweet, but I've been tweeting more. It's nice to be independent where you can say whatever you want. So Nordvig is a handle that I use. And then we have the Market Reader Inc. handle that we're using more and more to give you some snippets about what are some of the key insights from Market Reader. And we have it on the Exante Data side. We have a handle called at Exante Data. We've done some cool stuff lately that got a lot of attention there. And then in terms of if you want to follow writing, we have a Substack that is called Money Inside Out. That is actually a Substack we're using to talk to policymakers. Like we have a paid service at Exante Data that is behind paywall, but we have a lot of people from central banks who follow what we write on Money Inside Out. And that's where that brief history of dollar hatred I referenced earlier can be found. And we also have a blog on the Market Reader website, so marketreader.com, where you can follow our thinking there. So that's just click on the blog on marketreader.com and you can see what we're up to on that front. Those would be the main things I'll highlight. I think in terms of markets, it's an exciting time. I think 2023 is kind of transition year where last year was the up inflation year. This year, we don't know what's going on. And then I think there's going to be a lot more clarity in 2024. So be prepared. There's going to be some big moves when we really get through this part of the cycle here.
Yeah, be prepared for some big moves. Well, Jens Nordvig, founder and CEO of Exante Data and founder and CEO of Market Reader. It has been such a pleasure having you on the show. Thank you so much for being so generous with your time and your ideas. Really appreciate you coming on, Jens.
Thanks for inviting me. I'll do it another time if you have time.
Would love that. Thank you. Anytime.